Good evening, everyone. Today is the first trading day of March. Over the weekend, many of you likely followed the major headlines, especially reports about a joint U.S.-Israel strike on Iran, including claims involving Iran's supreme leader, Ali Khamenei. If true, such an event would mark a significant escalation in geopolitical tensions. The Middle East has always had a major influence on global oil prices. Over the weekend, we saw a sharp spike in Brent crude, particularly driven by concerns over whether the Strait of Hormuz could be disrupted or closed. The transmission mechanism is clear. Higher oil prices can feed into inflation expectations, which in turn intensifies concerns that the Federal Reserve may delay rate cuts or even consider rate hikes. At this point, market-based expectations have already pushed potential rate cuts further out towards September. That shift in expectations has a meaningful impact on overall market sentiment. However, today's stock market reaction was highly unusual. Let's first look at the indices. The only major index that closed lower was the Dow Jones Industrial Average. Why? Because traditionally, geopolitical conflicts and wars tend to impact sectors tied to global trade, industrial supply chains, and raw materials. The Dow represents more traditional industrial, retail, and consumer-oriented companies, which are more directly exposed to such disruptions. Yet even there, we did not see the kind of sharp sell-off many expected. Last week, we discussed this trading range and emphasized that it remained structurally healthy. On the final trading day of last week, we specifically mentioned that this consolidation range could persist for an extended period. Over the weekend, with escalating tensions, I was wondering whether the market might break below the range and form a topping structure, but that did not happen. Even more surprisingly, healthcare stocks were particularly weak today. Unexpectedly weak. In other words, the sectors we thought might decline actually rose, while the sectors we expected to show strength fell. The behavior was highly counterintuitive. Looking at the intraday action, the market initially dropped sharply, but within a single trading session, it largely absorbed the geopolitical shock and digested the impact on price action. Some analysts believe that the Middle East conflict may not last very long, unless the broader strategy extends toward full regime change, similar to what happened in Iraq. If the objective were to continue until a complete political transition is achieved, the timeline would be much longer, and the impact on equities would be significantly larger. At the moment, however, market expectations around Donald Trump are based on the perception that he operates with a business-oriented mindset, highly cost-conscious and efficiency-driven. The idea would be to achieve maximum strategic effect at minimal cost. If the operation had indeed been carefully planned over months and executed with precision, like a surgical strike, then the market assumption is that the duration of the conflict would be limited. That helps explain today's price action. What stood out most was the strength in technology stocks. The NASDAQ composite sold off intraday, but quickly reversed and closed higher. Software stocks, in particular, showed a strong rebound. In other words, within 1 to 2 hours of trading, the market appeared to fully digest the geopolitical shock and shift its focus back to the prevailing macro narrative: AI, technology, and software leadership. So despite the magnitude of the weekend headlines, today's intraday performance suggests that, for now, the market is choosing to look past the geopolitical event and return to the primary narrative. That's our current interpretation. Now let's revisit what we discussed at the end of last week. On the final trading day last week, we clearly said that the warning signal had been triggered. The alert was on. At that time, we emphasized that this was a serious signal. It even carried the risk of forming a topping structure, potentially a major top. That was our warning. It was not a prediction, but it was a clear caution based on what we were seeing on the chart. From a technical standpoint, the consolidation at the highs showed weakness. The price action in the middle of that range was not strong. The oscillation in that central zone was structurally weak. On the fundamental side, we also provided several supporting arguments. For example, traditional software business models face long-term disruption from AI. Persistently high inflation could eventually force the Federal Reserve into tightening again. There were also geopolitical risks and other macro uncertainties layered on top. Because of these factors, this stage of the market is difficult. Whether you are trading ETFs or buying individual stocks, it is not an easy environment. My suggestion during this phase is to remain patient. Aside from the specific names we've highlighted, it's better to observe more and act less. More observation, less aggressive positioning. Yes, the market quickly recovered. It moved from the weaker zone back into the stronger zone in a short period of time. But one key issue remains. The fundamental logic has not changed. And regarding the US-Iran situation, whether the conflict truly ends within the 4-week time frame that Donald Trump suggested, or whether it extends toward a broader regime change objective, makes a massive difference. If it extends into a long-duration conflict, the timeline becomes much longer, and the impact on equities would be substantially larger. All right, let's move back to individual stocks. Last week, we recommended several names. Do you remember? In particular, we emphasized CRCL, and today it moved higher again. This is why you must trust logic, trust structural reasoning. Think about which companies will benefit the most from the future financial architecture and the evolving technology landscape. I've explained the CRCL thesis 4 or 5 times already, but let me briefly restate it. In the emerging AI agent economy, CRCL currently has one of the most compelling narratives. We discussed before that AI agents will likely evolve toward decentralized systems. They will not rely on centralized credit card networks or purely sovereign-issued currencies controlled by a single authority. Yes, CRCL's stablecoin is currently dollar-backed, which is still tied to a centralized framework. But the technological infrastructure behind it can adapt to a future AI agent-driven financial system. That adaptability is the key part of the story. If the direction of AI development is becoming clearer, that AI agents will gradually handle most routine economic activities outside of entertainment, then payments become a critical layer. And in the payment layer, traditional centralized institutions may struggle to integrate seamlessly into autonomous AI to AI economic activity. Crypto networks, however, can. That said, not every cryptocurrency works for payments. For example, Bitcoin can take up to 30 minutes for confirmation. That's too slow for AI native transactions. The Ethereum main chain also has confirmation times that can be around a minute, still relatively slow. What's needed is near instant settlement, something like Ethereum Layer 2 networks. At the same time, payment rails cannot rely on highly volatile assets. A transactional currency must be stable. $1 should equal $1. £1 should equal £1. That stability is essential. Among publicly listed companies tied directly to stablecoins, CRCL is currently the only pure play option, since Tether is not publicly listed. We also strongly recommended Vertiv last week. I won't repeat the full thesis again, primarily data center liquid cooling infrastructure, but performance today was again solid. If you follow this channel, you'll notice that the stocks we highlight are carefully selected. Now, it feels like there's a lot to discuss, yet at the same time, not much has changed. Yes, conflict headlines emerged, but the market impact has been smaller than expected. However, the underlying fundamentals have not shifted. At this stage, portfolio adjustments should lean defensive, rebalance thoughtfully. I'm not encouraging aggressive short positions right now either, because the optimal technical entry may not have formed yet. The long-term transformation driven by AI is far more significant than any localized war or isolated geopolitical conflict. This is one of the largest structural shifts in human civilization in thousands of years. We must stay focused on the core narrative. Tomorrow, we'll continue monitoring whether the NASDAQ Composite and the S&P 500 remain in the neutral zone, searching for a new narrative driver, or begin to weaken structurally. For now, I am maintaining a level 5 alert, still a level 5 warning. That's it for today's update.